All right, well, we mentioned one of the big things markets are going to be watching this week is the decision on interest rates from the U.S. Federal Reserve. Last week, we saw our own Bank of Canada opt to stay the course, keep rates where they are. But there was an indication from Tiff Macklem and the Bank of Canada that we have seen a peak in rate hikes. But this story of rate cuts is what the market is really trying to get its head around. There's expectations in the market that we are going to see rate cuts this year. Our next guest has looked at what the performance historically looks like when it comes to rate cuts and the state of the economy itself as you move into that cutting period is very important for stock market performance. In other words, these so-called soft landings that everybody's been talking about, those are a very important variable when it comes to the overall performance for equities. Ed Clissold is Chief U.S. Strategist at Ned Davis Research, and he joins us now. Ed, good to see you. I guess let's start just with sort of as a strategist, what are you going to be watching for with the Fed this week? Are you assuming we just sort of stay the course on rates and maybe get a little language indicating that rate cuts could be in the future?
Yeah, John, I think that's the expectation for most people. We would agree with that. The Fed is not going to move this week, but they may provide some more information about when that first cut is going to come. Their language over the past few months has shifted from being rather hawkish, not really implying anything about a rate cut, to now it's a question of when. Is it going to be March, May, maybe a little bit later than that? That's what we're going to be keeping an eye on. But a rate cut this year, absent some sort of external shock, is certainly the expectation for the market and ourselves.
Okay, so we showed a chart as we were beginning our segment with you that highlights stock market performance when you enter into one of these rate cutting periods. And I think depending on, there's debate as to when we see a rate cut and how many rate cuts we ultimately see. But generally, when you begin that process of cutting rates, what is the importance on the economic side to determine what happens in the stock market?
A lot of it depends on where you are in the relation to a recession. So on average, the market does pretty well, up 15% 1 year after that first cut. But if there's that soft landing, there's no recession in the year after that first cut, then you're up about 24%. So it's a much better environment. Now, I think what may surprise some people is that even if you do get a recession, the market does pretty well a year later. The issue is that historically, the Fed was very reactive. They didn't start cutting until you're well into the recession. Stocks are already down a lot. You're already in a bear market. But probably stocks are going to rebound anyway, and the Fed added some juice to that. And so if you look at just the average with recession, non-recession, you kind of miss what has gone on before that first cut.
Okay, so bottom line, if you start to see rate cuts and the economy hangs in, that's generally a better situation for stock market investors.
Yeah, absolutely. So that soft landing that a lot of people have been talking about, and it does look like the Fed may just pull it off, is a very positive environment for stocks. You think about that 2022 bear market, that was really about interest rates cycling higher faster than what people had expected. And so if the Fed's able to reverse some of that, then that should provide a lift for the economy and for stocks as a result.
All right. In terms of the kinds of returns that investors should expect, and later in the program, we're going to talk a little bit about some of the historical charts when you have a positive January. The S&P 500 seems to be setting up for that kind of equation right now. An election year. There's a lot in the air that actually, when you look at history, look at new highs for the stock market coming out of a bear market, there's a lot to like in the historical charts. And yet we still seem to be sort of surfing on this sort of sea of worry right now. So what's your best sense on the path forward here, just in terms of sentiment within the stock market?
So you highlighted several we call technical or price action type of studies, and they all are fairly positive during U.S. election years. The market does tend to be a little bit choppy early on, and then as the election uncertainty resolves itself, the market tends to rally, and strong momentum tends to lead to higher stock prices. So a good January tends to be positive as well. There is some lingering concerns overall. First of all, the economy, just the idea that we are going to get a soft landing, but also from a technical perspective, that the biggest stocks, these mega cap tech names, Magnificent Seven, whatever you want to call them, are responsible for a lot of the gains. And I think what that might be missing is that you need to differentiate between absolute technicals and relative technicals. Some areas are going to lead. By definition, some are going to be going up more than others. That's just how stocks work. What you don't want to have is some stocks going up and then everything else going down. That's not what we're seeing right now. We're seeing nearly 70% of stocks above their 200-day moving averages. Same thing with 50-day moving averages. So it's just that these mega caps tend to have been doing even better. And so it does make things like large cap versus small cap. Looks like large caps are doing well. Some of these mega cap tech indices and benchmarks are outperforming, but that doesn't mean the market as a whole can't be healthy. And so we just got to differentiate between absolute and relative when you're looking at some of these technical indicators.
Before I let you go, just going back to that first chart that you showed us about if you've got that, dare I say, dream scenario where you can cut interest rates, but the economy avoids a recession. One of the tricky things, I mean, we sit here every day and we're trying to assess where the economy of Canada is going to land, where the U.S. economy is headed, and even technically, if we're talking about recessions in the U.S., we got to wait until there's a declaration from a specific body on whether we've had a recession or not. So you don't usually officially learn that until later in the game. What economic trends are you going to be watching to try to determine the health of the economy moving through the rest of this year?
Yeah. And first of all, I want to emphasize that the Fed the last few times has been more proactive, and sometimes it's worked, but sometimes it hasn't. And so the Fed cutting before the recession actually starts, that may or may not do the trick. But what we're watching this year, number one, is consumer spending, and with that, the labor market, because that's nearly 7% of the U.S. economy. And the last few data points for retail sales and jobless claims have been pretty positive. The other thing we're watching, though, is that on the fiscal front, in the U.S., 2023 was a massive fiscal stimulus. It really wasn't by design. It had to do with cost of living adjustments from Social Security, delayed tax receipts because of natural disasters. Those are probably going to reverse themselves this year. So we're going to have a little bit of a fiscal drag. We want to see how big that is and how much that's going to flow through to the rest of the economy. But if the U.S. consumer is okay, the U.S. economy is probably going to be okay, too.
Okay.